Hey everyone, welcome to the podcast today. We have a great CPA with us. His name is Brandon Hall, and I think you guys are really going to like the perspective and the way that their firm attacks most of the issues for investing, real estate, and also for tax planning. So Brandon, how are you doing?
Doing well. Thanks for having me on. I appreciate it.
Yeah, no problem at all, man. So first, of course, when people think of a CPA, some people think of the standard bookkeeping, right? But your firm is totally different. Tell us how your firm stands out from others.
Yeah, so we do all the basic services like bookkeeping and tax preparation, but I think that where we really stand out from the pack is we put every client through tax planning. Every client's going to go through some level of tax planning with us, and that's typically going to be a 30 to 60-day engagement where we tear your situation apart and help you understand what moves you need to be making now to mitigate taxes not only today but also in the future. And it's different from like a lot of tax planning. Like when I talk about tax planning with other CPAs that are in the industry, they think about like estimating taxes for clients. So in November, tell me what all your income was, and we'll estimate what your tax bill is going to be in April, so that you can plan to make a payment. That's what they call tax planning, and that's not what we do. I mean, we do that, but that's not what I'm referring to. And we actually started calling it tax strategy because we were trying to make a differentiation. So what we do is, if you come to us as a client, we're going to look at your situation. How many rental properties do you have today? What does your W-2 income look like? What's your spouse's W-2 income look like? What businesses are you running or interested in running? We're going to try to understand your goals. So where are you trying to go? Because I can throw out all sorts of awesome strategies, but if it doesn't align with what your growth plans are, then you're not actually going to implement them, and it's a big waste of time. So we're going to understand where you're at today, where to go, and then we're going to be proposing different things that you should consider doing and different things that you should consider implementing, such as, hey, instead of buying a single family rental, why don't we look at multifamily rentals, or why don't we look at strip malls, or why don't we look at short-term rentals? So we'll assess what you've got going on, knowing what we know about the passive activity loss rules, knowing what we know about all the stuff related to real estate investing as it pertains to taxes, will help you try to think through how to structure a portfolio. And a portfolio doesn't just have to be real estate; it can be businesses too. How do you structure a portfolio of income producing assets to overall, or to mitigate your taxes from a macro standpoint? We always like to talk about the Warren Buffett approach to investing. He doesn't pay less tax than his secretary, but his effective tax rate is less than his secretary's, right? So he pays millions and millions and millions and millions of dollars in tax, but compared to his total income, the ratio is much lower than what a secretary pays. That's what we want to help our clients do.
And so let's say you're talking to a physician, right? And so they have a large amount of W-2 income. And in their mind, they're trying to understand, why should they invest in, let's say, real estate or purchase a business outside of them going ahead and investing in the stock market? Do you often have people ask you that question?
Yeah, so we don't get too involved in like equities, like the stock market versus these other sort of assets, these alternative assets that you could acquire. Most of the time when people come to us, they've already made the determination that that's the route that they want to go. If they're still trying to decide, we will often rope in like wealth planners and things like that.
Okay, awesome. I can't hear you, Hank. Sorry.
Oh, I didn't say anything. I was leaning forward in my foxhole.
Okay. All right. So I know sometimes people make the issue, or make many mistakes, right? Can you tell us more about passive income benefits and how people may get that confused with other things?
Yeah, well, yeah. So there's tons of mistakes as it pertains to real estate taxation, mainly because it's so complex and it's so niche that you really need to, as I learned in running my own business and making many of my own mistakes, you have to have thousands of repetitions to really start getting it right on a consistent basis. So what happens is we get a lot of clients that come in, they're high income earners, they're high net worth individuals. We get a lot of physicians that are earning $600,000, $700,000, $800,000 a year, and their primary motivator is to eliminate their tax burden or significantly reduce their tax burden. And I always like, first off, I think that's a mistake. And I think it's a mistake because when you're focused on, when your reason for undertaking any investment is to reduce your tax exposure, it's something that like in a long-term environment or from a long-term perspective, I don't think that it makes sense because you're subject to political changes, you're subject to things that you can't necessarily control. I would rather see investors come in and underwrite a business or a piece of property and say, I'm going to buy this because it's a good deal. And also on top of that, I'm going to mitigate taxes. That's the way that we like to think about it. So the very first mistake is I think that a lot of people come in thinking that they're going to come in with the sole with the sole goal of reducing their tax exposure. And the reason that the further reason that that's a mistake is because they get sold by advisors, by gurus, by people that don't necessarily know what they're doing. They get sold on the tax benefits. Because think about it like this: like if I'm a physician and I'm making $800,000 a year, and let's say that you're selling a course on how to, or you're selling consulting services or whatever, on how to buy a couple of rentals that are going to produce $300 a month in cash flow. So if I take your course and your consulting, your promise to me is that at the end of it, I'll have 5 rentals that produce $300 a month in cash flow each. So I'm making $1,500 a month. Well, if I'm making $800,000 a year, I mean, that's what, $65K, $70,000 a month. Adding $1,500 a month is not very exciting to me, right? So the hook that we see people in the industry use is, oh, and by the way, I'm going to wipe out $100,000 of taxes for you. That's
how
the
frequently?
Well, right. How frequently? we're gonna wipe out $100,000 of taxes so sign up and I'll show you how. And so then you get the physicians and the people that are high net income earners to sign up for your course, your consulting services or whatever. But then they get into it and not really, the advisors we have found are not really clear on how the passive activity rules work, because when you buy rental real estate, it's all passive. So
right. I can
buy let's say a $500,000 rental property. I can run a cost segregation study, and I'll explain what that is in a second. I can run a cost segregation study on it, and I can create a $150,000 first year deduction. And if I can take that $150K deduction, it might create a $150K loss, might save me $90,000 in taxes. Actually, that's too high. $60,000 in taxes. So that's the promise, right? But then we get into Section 469 and the passive activity loss rules, and you work with a CPA that knows what they're doing, and then you come to realize you've been sold a sham. That $150K loss, it gets suspended and carried forward unless you do very specific things, which you're not going to have time to do because you're a physician earning $800,000. And those are the passive activity loss rules that limit your ability to do that. So the point is if you go into these things really motivated to reduce taxes, you will open yourself up to being sold on bad advice, and you won't find out until you prepare your tax returns, or you won't find out until you get audited. Yeah. Yep.
The audit will tell you.
The audit will tell you, and it will come. It will come. We tell almost all of our clients, prepare for an audit. This is serious stuff. Keep your records. It needs to be if you keep your records, it'll be easy because we're not going to put you in positions that are precarious. But if you don't keep your records, then the audits can be very painful. All
right. You said a buzzword you said a buzzword that Hank loves: cost segregation.
Yes. So cost segregation, it's the practice. So first off, all rental real estate is depreciated over 27 and a half years, straight line. So if I buy a $100,000 home, I allocate $10,000 to the land because you can't depreciate land. It doesn't deteriorate. Depreciation, when I say depreciation, it's a phantom expense that I get to claim every single year. So $100K home, $10,000 is allocated to land, $90,000 is allocated to the building. The building deteriorates every single year, so I get to claim depreciation. And the way that I calculate depreciation is I just take that $90,000 of value allocated to the building, I divide it by 27 and a half, and I take that amount every single year for 27 and a half years. I get to claim it every year. I don't have to pay for it every year. It's a vanity expense, and it's a tax adjustment essentially. So it's a thank you for investing in rental real estate. When I sell the property, I do have to pay a tax on all the depreciation that I've taken or could have taken. So don't fall victim to the, oh, I just won't pay. I won't take depreciation so that I don't have to pay it at some later point. You do have to pay it back. The IRS will assess it, even if you never took it. So you have to take depreciation. You do have to pay a tax. It's called a recapture tax whenever you sell the property on the back end. So depreciation tracks the deterioration of your asset over time. Rental real estate depreciated over 27 and a half years. If you have non-residential real estate, like commercial properties, short-term rentals, short-term rentals I know is a weird one, but the IRS deems them non-residential. That's all depreciated over 39 years. So 27 and a half years for most real estate, 39 years for non-residential real estate. Mm-hmm. A cost segregation study says, well, in that $100,000 example, I allocated $10,000 to land, $90,000 to the building. But the building is not just the building. Like there's stuff that makes up the building. There's windows, there's the roof, there's the HVAC system, the plumbing, the electrical system, the floors, the appliances, the countertops, the cabinets. And a cost segregation study says we should allocate value out of that $90,000 building bucket and into all of those other buckets too, to be a little bit more accurate. And what you end up with is you end up with value allocated to everything that I just named off. And those things can be depreciated, those components can be depreciated over a faster timeline than 27 and a half years. So personal property like appliances, cabinets, some countertops, carpeting, laminate floors, that's all personal property. It can be depreciated over 5 years or 7 years. Land improvements like my driveway, my parking lots, some landscaping can be depreciated over 15 years. So instead of waiting 27 and a half years to depreciate all this stuff, now I'm allocating value to a 5, 7, and 15-year bucket. I still have value, some value allocated to that building bucket, but maybe it's only $60,000 now instead of $90,000. So maybe I allocated $30,000 to 5, 7, and 15-year components, and now I'm left with $60,000 allocated to the building, which is still depreciated over 27 and a half years. So a cost segregation study allows you to, if I allocate value to my 5, 7, and 15-year buckets, I'm depreciating now over 5, 7, and 15 years rather than 27 and a half years. And effectively, that just allows me to accelerate my depreciation deductions that I get to claim every single year, at least for the first 5 years. On top of that, I can 100% bonus depreciate any component with a useful life of less than 20 years. So in this example, I had a $90,000 building. I allocated $30,000 to my 5, 7, and 15-year property, and that left me with $60,000 allocated to my building. Well, the $30,000 that I allocated to my 5, 7, 15-year property, I can immediately write off in the first year of ownership. So I buy this property for $100,000. I immediately expense $30,000 of depreciation, and that's going to create a passive loss. Can I claim that passive loss? Potentially, if I do a couple things to recharacterize it to a non-passive loss. But that's where everybody gets messed up.
That's the sticky part.
That's the sticky part.
I'm sitting here and I'm thinking there are a number of individuals who do fix and flips, and they have their cousin Bubba doing their taxes. So what I'm thinking is the possibility exists that they may be missing out on some benefits or opportunities because they're not using, they don't want to pay a CPA firm to help them to keep their business, for lack of a better term, in
the IRS looks at the flipping a little differently too.
Mm-hmm.
Like when it comes to
so if you're flipping homes, that's going to be considered inventory. You can't cost segregate inventory. You just accrue all of your costs. You don't get to claim any deductions until you sell the flip. So that's one mistake that we see is people will like, Like I buy a flip property in November, and I spend a lot of money rehabbing it, but I don't actually sell it till January of the next year. We actually see a lot of people will deduct all their flip costs, the acquisition costs, the improvement costs this year, even though they didn't actually sell the flip until next year. And that's incorrect. That's not the way that you do it. You got to match the expenses to the timing of the sale because it's inventory. So you can't cost that. But to your point, Hank, to your point, we do see a lot of people use cheap CPAs, cheap tax preparers, not even necessarily CPAs, just cheap tax preparers,
or
mom and shops. Yeah. Or do it themselves. Yeah. And that's a huge problem in real estate, especially because, you know, what a lot of people don't realize is the second that you buy one rental, you've just added an incredible amount of complexity to your tax returns. It might not feel like it, but you did. There's additional filing issues. And if you try to keep it simple, like if you try to keep doing the TurboTax and you try to keep it simple, you've got the one property, you know, you could probably do it, but to Hank's point, you're going to be missing opportunities. You're going to be missing opportunities with the passive activity loss rules, with cost segregation studies, with partial asset dispositions, with repairs versus capital improvements. Now, do you need to go and hire an expensive CPA? No, you do not. But you need to educate yourself on the different rules, because if you don't educate yourself, then you're unable to hold anybody accountable to good quality. You have no idea if what your CPA is telling you about the 1031 rules is correct. Or if your CPA says, yeah, you can deduct all your rehab costs before you rent the property out to your tenant. You have no idea if that's correct. So how do you know what amount of risk you're taking if you don't have any fundamental education in place? And this is something that I recognized. So in 2020, so I've always been part of sales, but in 2020, I took over our sales department because I wanted to reinvigorate it, essentially kind of rebuild it. And I talked to about 2,000 people in 2020, 2,000 prospects. Sorry, it's pollen out here. I'm not very good with pollen. Yeah. So I talked to about 2,000 prospects in 2020 alone. And I started recognizing trends. It's like late January 2020. I started recognizing this trend of just a ton of people coming to us where I would review their tax returns. There's mistakes, things that were missed. And so I started tracking it. And it was right around 80%. I think it was like 81 or 82% of all of the tax returns that I reviewed. So all 2,000 of those, and I didn't review all 2,000 people, but it was a lot. 81 to 82% had errors or missed opportunities in their tax returns. That's an incredible amount of errors and mistakes. Interestingly, most of those came from when people used CPAs or tax preparers. When they did it themselves, they had less mistakes.
Really?
Because they're more in, it's fascinating because they're more invested. My theory is that they're more invested in trying to figure it out, and they spend more time and they make sure all the numbers flow and they're like looking things up, versus a CPA is just churning and burning. So if you get a CPA that doesn't understand real estate, they're just forcing you through their process. Yeah. And they don't necessarily know if they got your quality check right. That's my theory. So I created the course, and it's a tax course for real estate investors, because what I realized is we're too expensive, and a lot of the good CPAs are too expensive for somebody that's got 2 rental properties. You know, like we're going to charge you $1,500 for a tax return, and that's really expensive for 1 or 2 rental properties. But you still need the basic information, the foundational information, so that you can go and hold your own CPA accountable. And I was just finding that people didn't even know where to have the conversation. So that was a solution that I had to potentially solve that. It's been working okay.
And Brandon, well. Brandon, for those who are listening to us, where should they go to gain access to that course, though?
Oh yeah, you can go to and thank you very much. Sorry, I didn't mean to interject a pitch. I'm really big on no pitching, but I appreciate it.
Education is important, and the lack of education is expensive.
Exactly. You can go to courses, www.courses.therealestatecpa.com. I believe that's the hyperlink. We changed it recently, so I'm pretty sure that's it. But courses.therealestatecpa.com, or you can go to www.therealestatecpa.com, hover over education, and there will be a link to it. But what we've done with the course, it's the 5-module course. There's 12 hours. There's some bonus sessions. You get access to a community group where you can ask questions and I'm in there answering, or somebody on my team will be answering questions. And we're really, really big on citations. So you'll hear us say over and over and over in the videos, it's okay to ask your CPA for citations. And it's okay to ask the cost seg folks for citations. And whenever you do, you've just elevated the conversation. Now you're holding them accountable to high quality, right? Because if a CPA comes out and tells you, yeah, if you have a suspended passive loss from a prior year that you're carrying forward, because I bought 5 rentals last year, I forgot about the passive activity rules, I cost segregated everything, and now I've got a $200,000 loss that I couldn't claim because it's passive and I don't have any passive income, and I couldn't make it non-passive. So it's a $200,000 loss that's now suspended and carried forward. If a CPA or an advisor or a tax preparer tells you, hey, next year when you qualify as a real estate professional, you can use those suspended passive losses. Now you get to say, can you give me a citation for that, please? Because what I learned in this course is that you cannot. Within section 469, it clearly says that you cannot. So do you have a citation that I can take back to Brandon and show them that they're wrong? Because we're happy to be proven wrong. We are very humble accountants, right? But we want to make sure that you have really good information in your hands so that you can have those conversations, because that's what was attributing that type of conversation was lacking in almost every single tax return that I reviewed that had errors in it. It's just a very clear, hey, if you would have just asked for this citation, or if you would have just asked one more question, you'd have avoided this mistake, or you would have capitalized on this opportunity. But you didn't know where to start.
Yep.
Right. And that's the issue when you're working with lower cost providers. You're the one that's ultimately responsible regardless. But when you're working with lower cost providers, you're the one that really has to be that quality control person. So you need to know what you're talking about.
Hank oftentimes makes jokes about a CPA that he knows, who lets him know that, hey, what we should do is let's file your taxes early, or let's prepare your taxes early, and whatever that bill comes out, we'll just go ahead and divide that cost up throughout the year. What do you say to people who have CPAs like that?
Well, like I said, I think that's what a lot of CPAs call tax planning. If you've already gone through our tax strategy, our consulting services, and we've got that plan in place for you, we'll do the same thing, estimating your quarterly tax bills. But if that's all you're getting out of your relationship, if there's no like strategic foresight of, okay, well, here are my quarterly tax bills, but now what are some moves that I mean, if you sit down and do that in January, good for you. Like, that's amazing. You've got the entire year mapped out. But then the question needs to be, all right, April, May, June, July, August, what moves do I need to be making during those months? What moves do I need to make by November to actually reduce this tax exposure? And the problem that I have with the quarterly tax planning too, because we work with a lot of entrepreneurs, a lot of real estate investors, is that I can make a purchase in December that like cuts my tax bill in half. So if I've been making these quarterly payments without planning for that December purchase, now I've overpaid significantly, right. And now I'm going to get a refund next year, which is great that I get the refund and that I did this tax planning or I made this year-end investment that helped. But I also locked up $50,000 and I'm not going to get that back until April of next year. So, it kind of depends. Me personally, I don't really personally, this is not very good advice. So, but it's just personally what I do. I keep all my money in my pocket and I just wait until the end of the year to see how all my income shakes out. And then I make a year-end tax payment at that point. However, that's not for everybody, because you do get nasty grams. You do have to pay interest. Yeah. Sometimes you pay penalties. But it's such a small amount compared to having that working capital on hand. So my personal philosophy is to do that. We used to do that with clients, but then clients would get mad that they got the nasty grams in the mail. So we actually stopped.
They didn't have the stomach for it.
Yeah. You got to have the stomach for it. Yeah.
So, Brandon, you mentioned something that's really important. When someone hears you say, "Oh, they purchased real estate," too many people think of, "Oh, I get a second house, right? I can go ahead and buy, this new condo that I want," and that's not what you're talking about.
Correct. I'm talking about rental real estate. I'm buying a property. I'm putting tenants into it. If you buy rental real estate, that is it's a great way to build wealth. I actually got into, when I started my firm back in 2015, I chose real estate as a niche to service. So we only work with real estate investors, and then real estate investors who are also entrepreneurs. We work with those folks. But I chose real estate because I wanted to see if I should be investing in real estate. So I wanted to see behind the curtains, like, does this actually make people wealthy?
Interesting.
And it's an amazing wealth building tool. You get the cash flow, you also get the appreciation. It's an amazing wealth building tool, but it's also, what I learned is it's an amazingly tax efficient tool. It's an amazingly tax efficient asset class if you structure it correctly. So if you're buying rental real estate, you can most certainly not pay tax on the rental income that you're receiving. And in most cases, you can figure out ways to use the losses. And when I say losses, I don't mean operating losses. I mean tax losses from my rental real estate. So I can use those tax losses from my rental real estate to offset my other income, W-2 income, business income, stock income, dividend, interest income, business income. But I've got to plan it. I've got to plan for that. I've got to structure it correctly. And if you do that up front, you can generally reap the tax benefits.
Mm-hmm.
Wow. I'm sitting here thinking, and we've talked to a couple financial planners, and and I was telling Leland that I don't have a negative view of financial planners, but they don't talk about tax strategy. If they talk about tax strategy or tax planning, it's saying, well, Brandon, what you can do is you need to get another insurance policy as a way of safeguarding, this investment or what have you, and it's interesting because their clients are maybe losing money hand over fist because they're not getting good advice from the planner or their CPA or their cousin. Because, or a friend, because it's not one size fit all. So do you do collaborating, partnering or what have you with other professionals who have some some aspect of professional planning or services or what have you for your clients?
Absolutely. I think it's really important for clients to understand that you can go to any one professional and get their opinion about a lot of different things. Like, you can always come to a CPA and get their opinion about how many entities should I set up, or should I be investing in the stock market? But and hearing their opinion's fine, right? Because I think it's important to hear what other people's experiences have been like. But you should also always take it with a grain of salt. Hey, my CPA is an expert in tax, maybe not wealth planning, maybe not legal. So what that means is I should also go to the financial planner. I should also go to the attorney, and I can ask the attorney about taxes, and the attorney can give me their opinion. But I should recognize that they're not the tax expert, they're the legal expert. So I got to always take that with a grain of salt. And same thing with financial planners. Financial planners may be great at asset allocation. Actually, a lot of financial planners don't like real estate. They don't touch real estate. They don't understand how real estate works, but they also can't earn fees off of real estate like they can,
That's it.
Right. So,
see, Brandon, I'm glad you said it, because I didn't want to say that. See,
hey, look, we work with a lot of our clients actually get rid of their financial advisors or will not work with financial advisors because of that reason. And they start looking to us to help them with investment advice. And so we're like, well, we need to find a subscription-based financial planner or something for you. Somebody that you pay $100 a month and you can have a couple calls with, or they keep you on some sort of schedule, or where they truly believe in real estate as an asset class and they can show you the data as to why, but they're not concerned with pulling in 1% management fees on whatever you invested in real estate. So you got to take you got to understand where people's motivations lie,
Mm.
right?
Mm.
Like especially it's wrong, not to overly bash financial planners, but it's just another example. You know, people that sell whole life insurance.
Yeah.
Well, it can make sense for some people, but does it make sense for literally every single person? Probably
No way.
not. But you got to understand, like, how is this guy getting compensated? Attorneys do the same thing, right? They'll set you up with these exorbitant structures. I mean, we've had clients come to us, physicians, because physicians are you know, they make a lot of money. They already know that they're
Walking
a high risk
lawsuits.
profile. Yeah. Yeah. And so they buy into the fear that they're going to get sued no matter what. They're 100% going to get sued and all their assets can be taken away. So they go to these attorneys and they're like, oh, you need to set all these crazy trust structures up and $40,000 and we'll get it done for you. And it's like, well, do you really need that though? Or like, will an LLC work for you? Will something simpler work for you that maybe only costs $1,000 to set up? And you may need to pay the $40,000, but the point is just to always question it. And CPAs, you know, they do the same thing. Like we've seen CPAs sell clients on just these insane tax benefits.
Mm-hmm.
And then you come to prepare the tax returns and you realize, oops, you know, the passive activity loss rules eliminate all of that for me. So it happens in every single industry, but you just gotta, it's always buyer beware. As a consumer, you have to be really careful with professional services. You got to know how everybody's getting compensated. What are all the back end deals, the referrals going on, the affiliate agreements? You got to be aware of that stuff before you go and pull the trigger on these services.
Yeah.
You mentioned the word trust as a not as an emotion, but as a
Structure.
structure.
Yeah.
Do you advise any of your clients that possibly they need to look at trusts as part of this tax haven that we're skirting on?
No. The IRS has an entire page dedicated to abusive trust tax schemes. I would highly recommend anybody listening to this, if you've been pitched trusts as a tax savings vehicle, you should go Google that IRS webpage and read about it. You can certainly save money with trusts, depending on the type of structure, but you're typically, you know, there's charitable remaindership trusts, there's spendthrift trusts, there's different types of trusts, but you got to understand with trust, typically the way that it works is in order for me to save money, I've got to give money away to somebody else, whether it's a charity or an heir that doesn't know how to spend their money. I have to put $1 in to save 30 cents. And it's just like charitable contributions is really like what it's like at the end of the day. At least that's been our experience with it. I've yet to see a trust tax structure that saves an incredible amount of tax money and is also legal. A lot of these trust tax structures that people are pitching, first off, they make a ton of money with the setup up front. They also make a ton of money in the management fees on an ongoing basis. And they're typically based on like one tax court case or one private letter ruling or one CCA, just like one small blip. And so it's just important to know that if you're going to go and set up these trust structures, that you carry the appropriate insurance, that your advisor carries the appropriate E&O insurance, and that you understand that if you're doing it for tax purposes, you might be facing some sort of audit later that does not go your way. You might be going to tax court and you might lose, and you got to have recourse for that.
In your experience, have you run into any what do they call family office environments? Family office as part of the wealth creation and what have you?
Yeah, absolutely. Yeah, for the ultra high net worth folks, they will have family offices, and we'll work with the family office on different tax strategies. They do typically implement a lot of different trust structures.
Yeah.
But again, like we have to be really careful. You know, the difference between tax avoidance and tax evasion can sometimes be a very fine line. So we got to make sure that we're on the right side of it.
Well, Leland encouraged me to watch a movie called Laundromat, and it was
on Netflix.
It was chilling in the sense that people were taken advantage of without realizing that they were being taken advantage of. You know, they put too much trust in professionals, for lack of a better term. You know, and that's what I've been hearing you say. Sort of like trust but verify.
Yeah.
And,
Yeah.
you know, and if a person's motive is, lack of a better term, take advantage of you because you can because you might be able to afford something, you gotta get out of that relationship
Really quick.
so somebody suppose someone wanted your services because I'm intrigued because we've talked to a couple of attorneys and you just seem to have a tremendous understanding, not of the accounting aspects of, but the tax aspects of the accounting framework. If I hope I'm making some sense there.
Yeah.
Yep.
Yeah. So
oh, go ahead.
No.
Oh, sorry, you're gonna ask a question.
I was just gonna say, what was it that drove you to become a little bit more meticulous about the tax implications of accounting?
Oh, that's a great question. So first, just to back up, because I want to comment on the trust but verify. That's so true. We work with a ton of great professionals. There's so many great, smart people out there, but the one thing that the great people tend to do is be transparent and honest with you about what your options are, and not try to overly sell you or push you in any one direction. So for anybody listening to this, if you're talking with a professional, if it sounds too good to be true, and if that also comes with a $10,000, $20,000, $30,000 price tag, you need to be verifying it. You need to be verifying it get multiple opinions, talk to multiple attorneys, talk to multiple advisors, tax pros, financial advisors. Don't buy into the hype. What a lot of people fail to realize is that a lot of these service professionals can be very good at sales, right? So here I am, I can talk to you all day long about real estate professional status. Real estate professional status allows you, how the whole rental losses I was just talking about, you can't, if you can't use them, they're suspended, they get carried forward. Well, if you qualify as a real estate professional, you can use them in the current year, right? So I can tell you all day long what it takes to qualify as a real estate professional without ever telling you whether or not you can qualify. But I can spin that in a way. I can spin that in a way where I could probably get you to spend $5 to $10 grand with me, just to learn more about it, and we can analyze your situation to see if you can qualify. Now, I know
it's too late
at the very beginning. Yeah, I know at the very beginning on the first sales call whether or not you're going to qualify based on the information that you tell me. Doesn't matter. I can sell it to you. I can get you all hyped up and spun up. And then after you spend $5 to $10 grand with me, I can say, oh yeah, like actually this isn't going to qualify, but here's some other things that you can do, or here's when you can qualify. You're going to walk away disappointed. So to answer your question, Hank, trust but verify, but also, why are we meticulous about it? Why do we do it this way? Because we've seen shoddy sales people. We've seen professionals implement a little bit of a sketchier sales process. We've seen advisors not fully understand what they're pitching to somebody or what they're implementing with somebody, only to later find out that it doesn't work that way. We've helped people with the audits, and they all lose because it's too late at that point. You lose. Now you're just negotiating with the IRS on a settlement. We've just done that too many times, and I believe that there's I believe that most of our clients value peace of mind above anything else. And so we want to give them the peace of mind, and we're going to be transparent. And we pride ourselves. If you watch any of our content, listen to our podcast, watch our videos, watch my LinkedIn, Facebook posts, you will see from time to time that we reiterate, we tell clients what they need to hear, not what they want to hear. A lot of clients want to hear that you can save $50,000 by qualifying as a real estate professional. They want to hear that qualifying as a real estate professional is easy, because nobody wants to work hard to save the $50,000 in taxes. And most CPAs, to win the client and win the advisory fees, will tell you exactly what you want to hear. Oh yeah, you can do that. You can count those hours. Education hours count towards real estate professional status hours. No, they don't. Why? Well, why does the client want to hear that? Because education hours are easy, right? You could be listening to this podcast right now, counting this hour towards your real estate professional status because your CPA told you so. But guess what? That hour doesn't count. And we tell people what they need to hear to win IRS audits and to sleep well at night. It's just something that we do.
Wow.
I want to say something real quick about the trust. Have you heard a lot of noise about potential taxes on inheritance and things like that?
Yeah. So the Biden administration has talked about it multiple times. I don't know. It'd be really interesting to see what ends up happening. I mean, obviously, with all the economic stimulus, somebody's going to have to pay at some point. But I would be surprised to see any sort of inheritance, any sort of wealth tax. You know, the thing that they've been talking about is eliminating the stepped up basis rules. So if I own a rental property, let's say I bought it when it was $100,000, it has since appreciated to $500,000. I die, I pass it to my son. My son inherits it with a basis of $500,000. So what that means is if he sells it, he takes the fair market value, $500K, and he subtracts his basis of $500K, and he's left with a $0 gain. If they eliminate that, then he's selling it. He's taking the fair market value of $500,000. He's subtracting my basis of $100,000, and he's left with a $400,000 gain. Then he has to pay tax on that $400,000 gain. So the stepped up basis, that happens when I die and I pass assets on. They have talked about eliminating that, but I would be surprised if they do, or if they do that anytime soon, because that is a wealth tax. And Biden has historically been relatively moderate and against wealth taxes. I don't know if that's changed in recent history, but that's my understanding of how he has acted historically. So it'll be interesting to see if something like that actually happens. I'm not confident that it will.
Okay, cool. That's good.
But I could also be watching this podcast a year from now, eating my words.
Then,
so.
Fingers crossed.
Yeah.
I get it.
Right.
We don't know what they're doing up there.
Right.
You know, it's this has been eye-opening for me, because the more we talk to smart people, the more I realize how dumb I really am with certain aspects of stuff. And it's being a little bit revealing. You talk to people, you think you know, you do your little research, you think you know, you think you're smart. But this is something, Brandon, that you live and breathe and every day. And it's your business to know the rules. And most people will tune into a podcast or take a quick course, and it satisfied an immediate need in their minds. And they don't realize the minefield that they're setting themselves up for, because they want to do it cheap. So I guess what I'm saying to people that are out there listening, no matter how smart you think you are, pay a fee to get good advice, or sit and chat for 15 minutes to see if this is somebody you really want to help you to do stuff.
Yeah.
Because if you get the wrong person to help you to do the right thing, you're gonna pay a lot more money.
Oh, 100%. What I've realized in my short life is that everybody's just trying to figure it out. Everybody's trying to figure it out. It's amazing. Like even these highly accomplished, experienced professionals are still just trying to figure it out. You know, they know most things, but they're trying to figure out. It's fascinating. And like even for me, like we've gone through we have 640 clients. They're all in real estate, every single one of them. Collectively, they probably own, I don't know, $1 billion or so in assets. We help advise on that all day long, and we're still figuring it out. we make mistakes. We make way less mistakes than we used to. But man, some of this stuff is just so niche and so complex that you find out that you told somebody something wrong a week ago after this new situation pops up. And even too, like I've got an amazing attorney. I've got this attorney at this law group. They've got 200 attorneys. These guys are sharp, right? They make you feel real good when you call them up. It's okay, Brandon. It's all good. You're going to be fine, right? Make you feel real good, real good. But while I trust my attorney with my life, I still do just enough research to ask the right questions. I'm not going to figure out how to tick and tie. I'm not going to figure out how to dot the I's and cross the T's. I'm not going to figure out where to position the commas, where to position the semicolon. I'm not going to do that. I'm going to let the attorney do that. But I'm going to ask just enough questions. I'm going to do just enough research to understand the topic so that I can ask the right questions to make sure that we're driving to the result that I'm looking for, right? A lot of people will just sign the Apple terms of agreement without taking a second look at it. What are you signing? What are you signing? I know that's an extreme example, but you start applying that same logic to business, you would be shocked how many of our clients just sign purchase agreements, sign lease agreements without even batting an eye, without looking at it. We had a client one time, we sent it was a huge tax return. It was like a 600-page tax return. Okay. Send it to him. 5 minutes after we sent it to him, he says, "Cool, where can I sign?"
No, he didn't.
Come on, man.
He trusts you. He trusts you. Seriously.
Look, I get it. But and we may have a great relationship. We may have a 5-year relationship where he does just trust us immensely, and that's fine. But where else are you applying that mindset to, where you're not doing enough due diligence? You don't have to do like an insane amount of due diligence, but you need to do just enough so that you can ask the right questions.
That's right.
But Brandon, again, for that client or any other client that has hundreds of pages of a tax return, even though you prepared it, whose responsibility is it for those 600 pages?
It's the client, man. At the end of the day, it's the client.
I mean, say it again. Say it again.
Just so they know.
It's the client's responsibility. Here's another thing.
Ultimately, no matter what it is, when Hank Hunt signs this document, he's taking full responsibility. Now, I'll help argue my case, but at the end of the day, who goes to jail?
Right.
That's right. Wesley Snipes. That's right.
Here's the other thing too that a lot of people don't realize about tax returns specifically. As a CPA or as your tax preparer, I only need a 50% chance of a tax position being upheld in order to take the position, which means that I can be relatively aggressive and face zero consequences, which means that if the tax position fails, right? If the tax position fails, but I had reasonable basis to believe that it could have succeeded. What is reasonable basis? It's relying on that one tax court case, like all these trusts, these crazy trust structures, right? If I had reasonable basis to believe that it could have succeeded, you can't sue me.
and real quick. So, and Brandon, I know we're coming to an end. I have three questions for you. What do you say?
Be careful. Be careful.
What do you say to that physician or, even that athlete, right? Who thinks in their mind that all they have to do is earn a little bit more money, but they don't understand, but they're not implementing a tax planning. What do you say to them?
Well, over the next couple of years, every additional dollar that you earn is going to be taxed at a probably 55% rate. plus state tax. So if you're in California, you're going to be seeing 65-70% rates on your dollar. So tax planning is critical. Tax planning is critical. You want to be moving your money into assets that are tax advantageous, such as real estate, such as passive business ownership. Especially if you can couple passive business ownership, like if I could buy a laundromat or if I could buy a hair salon and not materially participate, then it's passive. And then I can go and buy rental real estate and I can do that cost segregation study. I can use the bonus depreciation to offset the income coming from my passive businesses. So you can you can structure that, but you got to be thinking about it now, especially with these rate changes coming up. Mm-hmm.
Brandon knows it. Brandon knows it.
No, he does. He does. I get, I'm sitting here with bumps of the goose. I mean, he just lays it out there. Really appreciate your candor, sir.
Yeah. One more question or two more questions, Brandon. The next one is, if you could buy one business, what would it be and be a passive owner? What would that business be?
Gosh, I would probably buy a hair salon.
Okay.
If you look at the pandemic, I mean, everybody needed haircuts, right? I went, all the hair salons around us closed down in Raleigh at the beginning of the pandemic in 2020. My wife cut my hair. And we actually did a really good job, right? We teamed up, and I always watched the stylist, so I kind of like knew what to do. Obviously not as good as the stylist, but I kind of knew like where to cut and how to do it all. So we cut it all. And at the very end, my wife says, all right, I'm going to even out the back. Now, when I hear even out the back, I hear, and I think I've actually asked a lot of my male friends this. What do you hear when you hear even out the back? What does that mean? What that means is I'm going to even out your neckline, right? I'm going to make it straight because right now it's like a little curvy. So I'm going to make it straight. So she had the hair clippers without any sort of guard on it. I thought, okay, she's just gonna press on my neck and then press down to give the square neckline. Well, she takes the clippers upwards and just stripes me. Yeah, it gives me a big old white stripe. I turned around and I was like, what the F? I was like, what was that a joke? Was that are you pranking me? She's like, no. What do you mean? So
we only see the front. We only see the front.
Yeah, exactly. Fine for Zoom calls, right? I actually did a webinar and I spun around and nobody thought it was hilarious. But yeah, so I've been going to my hairstylist after that, and I was, it's amazing how packed they've been, even during the just resistant, economically sound. If you can get good operators in there, it can be relatively passive. Everybody needs haircuts, so hair salon.
And you can also have the real estate with that business too.
You can have the real estate, yep.
On it all.
And the equipment, I guess, if you have the big equipment there too.
Yep.
All right. Yep. Last question, Brandon. Where can people find you, and what could be their next steps to getting started with your practice?
Yeah, feel free to navigate to www.therealestatecpa.com. You can get a lot of our educational content there. You can click on the big Become a Client button if you're interested in exploring our services. If you want to connect with me personally, hit me up on LinkedIn. Just Google Brandon Hall CPA, LinkedIn. You'll find me on LinkedIn. Feel free to connect with me there. And we also have a private Facebook group for real estate investors called the Tax Smart Real Estate Investors Group. I think that's what it's called. But you can find that on Facebook as well. About 1,600 members. People are asking tax questions all day long, and our team's answering them.
That's awesome. That's awesome. All right, guys, we're going to put those websites in the description. And Brandon, thank you so much.
This has
Thank you guys.
been awesome. Thank you.